Thanks very much, Anil. It's great to be here and see a lot of familiar faces. Despite elevated levels of uncertainty, the U.S. economy continues to be in a good place. The labor market is solid, and inflation has moved closer to our 2% longer-run goal. At the Fed, we are intently focused on our dual mandate goals given to us by Congress: maximum employment and stable prices. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we are well positioned to wait for greater clarity. Policy is not on a preset course. If the economy remains strong but inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our mandate. Many indicators show that the labor market is solid and broadly in balance. The jobs report released this morning showed employers added 151,000 jobs to payrolls in February, and the unemployment rate ticked up 0.1% to 4.1% last month. Smoothing over the month-to-month volatility, since September, employers have added a solid 200,000 jobs a month on average. The unemployment rate remains low and has held in a narrow range between 3.9% and 4.2% over the past year. The jobs-to-workers gap has narrowed, and the quits rate has moved below pre-pandemic levels. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. With wage growth moderating and labor supply and demand having moved into better balance, the labor market is not a significant source of inflationary pressure. For inflation has come down a long way from its mid-2022 peak above 7%, without a sharp increase in unemployment. A historically unusual and most welcome outcome. While progress in reducing inflation has been broad-based, recent readings remain somewhat above our 2% objective. The path to sustainably returning inflation to our target has been bumpy, and we expect that to continue. So you look through those things if you can. So if you put that in the context of tariffs, I think if you look at where forecasts are, look at the blue chip, look where everybody's forecasting some inflation effect from tariffs. So it's very likely that if tariffs are imposed, and let's remember, we really don't know what's happening yet. We're at a stage where we're still very uncertain about what will be tariffed, for how long, at what level. We're going to have to wait to see all of that. But the likelihood is that some of that will find its way. It'll hit the exporters, the importers, the retailers, and to some extent the consumers, and we'll see what that is. And in a simple case where we know it's a one-time thing, the textbook would say look through it. But I think the situation, you would want to also be sure of a couple of things. One just is that if it turns into a series of things and it's more than that, and if the increases are larger, that would matter. And what really would matter is what's happening with longer-term inflation expectations and how persistent are the inflationary effects. You want to look at all of those things, and you'd want to remember the current context, which is we came off of very high inflation, and we haven't fully returned to 2% on a sustainable basis. So you got to put all that in the mix as you make this decision. That the government data we get from government gathered data we get from the Bureau of Economic Analysis and the Bureau of Labor Statistics is incredibly important and really the gold standard for data. Being able to track what's going on in the economy is very, very important, and it's something that the United States has led in for a long, long time, and something we need to continue to lead in. It's true that survey responses have gone down, and that some of the data have become more volatile. That just means it's something we need to keep doing and invest in. So I think that's important.
Do we understand why that is, and does that
Federal Reserve Chair Jerome Powell's recent remarks at the University of Chicago Booth School of Business Economic Forum provide critical insight into the central bank's strategic approach amid heightened economic and policy uncertainty under the new Trump administration. Powell's speech, emphasizing the importance of separating the signal from the noise, reflects a cautious stance, where the Fed is prepared to delay interest rate cuts until it gains clarity on the administration's policy trajectory. This approach comes at a volatile time, with markets reacting to Trump's aggressive trade policies, ongoing inflation concerns, and shifts in fiscal regulation. Powell's statement highlights that the Federal Reserve sees no immediate need to adjust interest rates, reinforcing the bank's data-driven approach. While some economists and market analysts have called for rate cuts to stimulate economic activity, Powell made it clear that the Fed is in a position to wait and observe. His remarks suggest that the central bank is focused on ensuring economic stability rather than responding hastily to short-term market fluctuations. This cautious approach aligns with the Fed's mandate of maintaining stable inflation and full employment. Powell noted that inflation expectations remain mostly in line with the Fed's 2% target, and despite some short-term variations, long-term indicators remain stable. Additionally, the labor market continues to show resilience, with the U.S. economy adding an average of 191,000 jobs per month since September. These factors give the Fed the flexibility to adopt a wait-and-see approach rather than making preemptive moves. Powell acknowledged that uncertainty remains high in these areas, making it difficult to predict their full economic impact. The Fed's decision to wait for clearer signals suggests a commitment to prudence over reactionary policy moves. Financial markets have been particularly sensitive to Trump's erratic trade policies, and Powell's speech further underscored the importance of stability. The decline in stock markets and bond yields following Trump's tariff threats exemplifies investor concerns over potential economic disruptions. The Fed's measured approach signals to markets that it will not react impulsively to political developments, but will instead prioritize long-term economic fundamentals. Powell's remarks reaffirm the Federal Reserve's commitment to a methodical, data-driven policy approach. While the Trump administration's economic policies introduce new complexities, the Fed is choosing to remain patient, assessing their impact before making any significant monetary policy decisions. This cautious stance underscores the Fed's role as a stabilizing force in an increasingly unpredictable economic landscape. As the months unfold, the Fed will continue to monitor economic indicators, market reactions, and policy shifts. Should inflationary pressures rise or economic growth slow more than expected, the Fed stands ready to adjust its stance. For now, however, Powell's message is clear. Patience and prudence will guide the Federal Reserve's path forward.